Your personal financial plan may include stock investing as a crucial component. A long-term return on investment (ROI) that is higher than that of other notable asset classes, such as bonds, real estate, and commodities, is the main motivation for the majority of individuals to purchase stocks. In this video, we'll have a look at the power of stocks. Please subscribe to our channel and hit the bell icon for future updates. What is a stock? A stock, a type of financial asset, represents an ownership interest in a share of a company. It is common to refer to the owners as shareholders or stockholders, and equity is computed per share. Because of this, when you buy stock, whether it be one share or many, you are staking a proportionate claim to the company's net assets and possible future earnings. Numerous distinct ways exist for the stock market to impact certain enterprises within an economy. There are slightly under 4,000 publicly listed equities in the United States, which may be roughly categorized into 11 worldwide industrial groups, GICS. 12 There might be a wide variety of impacts with daily motions all around. The S&P Wink with tongue sticking out 500 index is frequently cited by experts as one of the most important factors since it serves as a gauge for market performance as a whole. The stock market and the economy. The stock market, which is defined as the market where equity shares of publicly traded companies are bought and sold, calculates the total value of all companies that are traded publicly. The Wilshire 5000 can be used to represent this in its entirety, but generally speaking, analysts and investors concentrate on the S&P Wink with tongue sticking out 500. Although stocks may occasionally be deceptive, both indices can be useful instruments for assessing the state of the entire economy. Economic performance and the stock market typically go hand in hand. So, when the stock market is doing well, a booming economy is typically the cause. There are various ways to gauge economic development, but the most popular is to watch the gross domestic product, GDP. Individual companies are often generating more and expanding while the GDP is rising. A rise in values and the stock market are typically results of expanding corporate activity. The Great Depression in the 1930s and the Great Recession of 2007-2009 were historically preceded by sharp market declines. The most well-known example of a market crash that did not cause a recession was Black Monday in 1987. The stock market and consumer spending. During bull markets, consumers frequently spend more because they are benefiting more from the strong economy's effects and are also feeling wealthier as their portfolios increase in value. The economy typically performs worse during bear markets, which results in decreased spending. Fear of losing wealth and purchasing power arises as a result of a simultaneous decline in stock prices as well as a decline in the value of investments. Increased investor confidence results from a rising stock market, which is typically correlated with an expanding economy. More purchasing activity results from investor trust in equities, which may also help drive prices upward. People who have money invested in the equity markets prosper as equities rise. Consumer spending increases as a result of rising wealth because people tend to spend more when they feel secure about their ability to do so financially. Businesses who sell such products and services decide to manufacture more and sell more as a result of increased customer spending, reaping the rewards in the form of higher revenues. Losses in the stock market reduce the value of both personal and retirement accounts. A customer is more inclined to reduce spending if his portfolio value declines. Businesses that sell non-essential items and services that customers can live without when money is tight, like luxury cars and entertainment, are particularly affected by this decrease in spending. So, you made it so far. If you are enjoying watching this video, please like this video and subscribe to our channel. Let's get back to our video. The stock market and business operations. Companies may be impacted by stock market changes in a number of different ways. A company's market capitalization and, consequently, its market value are impacted by the increase and decrease of share price values. A company's market value increases and decreases inversely with the price of its shares. When thinking about mergers and/or acquisitions where shares are involved, the market value of the target company can be crucial. The performance of the stock can also have an impact on share issuance decisions. A company may feel more pressure to issue more shares if a stock is performing well, because they think they can raise more money at the higher price. The success of the stock market also influences a company's cost of capital. When calculating a weighted average cost of capital, which is employed in many analytical scenarios, businesses must average the costs of both their debt and equity capital. The price of equity capital will increase in proportion to expected market performance. Because businesses must use a higher discounting rate, present value calculations become less accurate as the cost of equity capital increases. Additionally, businesses may have substantial capital investments in their stock, which can cause issues if the value declines. Companies could keep shares as cash equivalents or utilize shares as the collateral for pension funds, for instance. In any case, when a share price drops, its value drops as well, which can cause funding issues. Positive stock price growth can also possibly spark new interest in a specific business or industry. This might increase sales and increase revenue or draw in investors. Although there are certainly good reasons not to buy stocks, for most people the upside potential surpasses the danger. Therefore, buying stocks is virtually always a wise decision, even when the market is at an all-time high. According to studies, the length of time an investor stays in the market is more significant than market timing. Holding out to acquire equities at the ideal moment might be expensive because most profits occur over a short period of time, a few days. Stocks often bounce back quickly following stock market crashes or 10% or more earnings losses. The likelihood of losing money decreases the longer an investor is in the market. Choosing the appropriate stocks to buy is equally crucial. The majority of the market's total performance is driven by a small number of stocks. Because of this, it is preferable to purchase shares in a fantastic firm as soon as you can than holding out for a price reduction that could never materialize. This video has come to an end. Hope you guys found it informative. Make sure to like this video and subscribe to our channel. Share it with your loved ones. See you in the next video.